Alright, for everyone in my Discord, I'm gonna go over, and just anyone in general, I'm gonna go over my system and what I use and how I use it on futures to be profitable. I'm gonna do this in three segments. So the first segment is just gonna be the support and resistance. The second is gonna be the opening range break for confirmation and TPs, and then the third are gonna be the EMA clouds. So the market is still open currently at this time. So one of the things I look for going into the day is I'm going to go on the hourly, and when the market is closed, what I look for is for the previous session. So today's Friday, so I'm going to look at Thursday. So we can see right here on the top right that it says open, high, low, and close. So if you're kind of having a difficulty of identifying these previous day highs or lows and the previous day close, this is what you're going to be looking for. So, with that being said, I'm looking at Thursday, going into Friday. I'm going to mark the high. I'm going to mark the low. This is non-negotiable. You're always going to mark the high and the low. I always do actually mark these out text-wise. So I do PDH was previous day high and previous day low. You can have these on the right side, left side, middle, however you want to do it. Um, The next thing I do end up marking is the previous day close. So, as you can see, the previous day close was 9:29. Right about here. That was the previous day close. Like I said, I identified that up here. So, I'm going to go back on the hourly. So now we have the previous day high, the previous day low, and then the previous day close. Now, going into the session, so we mark these out. Going into the next day, what I do is I will mark the pre-market high and the pre-market low. So you see that the pre-market high is pretty much just previous day close, so there's really no reason to bother, but you should do that. It's a good habit. As we can see, this is the pre-market low, and as also you can see, it is the new session, the new weekly low. So going into the next day, well, into that session rather, you can kind of see that we have a bearish outlook going into the day. So with that being said, if we're in between the previous day low and the previous day high, we're going to chop. As you can see, not much action. We're kind of stuck in the middle, but you can see right at 10 a.m. and right at 3 p.m. almost close here, you can see that we had a break of that structure, right? That's because when you're inside of a previous day's range, you're not going to be bullish or bearish, you're just going to chop. And you don't want to take trades. So stop forcing trades in that. And another thing is, I see a lot of you guys chasing the gap ups and gap downs. You shouldn't be shorting anything on a gap up, and you shouldn't be longing anything on a gap down unless there's a confirmation or gap fill. I'd see too many of you guys just getting destroyed doing this, and it's just kind of weird. So, with that being said, that is the first segment, is the previous day high, the previous day close, the previous day low, and the pre-market low and the pre-market high. So, with that being said, you're not going to be long unless you're breaking above previous day high or the previous day low, you're not going to be short. I like to mark the previous day close because it's more of a neutral, right? If we reclaimed it, we're neutral. Okay, so we're neutral. It kind of gives you that standing ground. Okay, going into the opening range break. Now, The first 15 minutes, you really shouldn't even be trading anyways. Let the trend establish. As you can see today, we gapped down, then we did have a little bit of a buyback, a little bit of emotional buying, and you can see we snap back down. We snap back down. So what you do is you're going to mark the first 15-minute high and the 15-minute low. Now, as you can see, unless we build above or under them, we're not going to be targeting back to a bullish. If we're building above, we're not going to be targeting the bullish outlook. And if we're building below it, we're not going to be, sorry, let me reiterate that. If we're building above it, we are having a bullish outlook and we shouldn't be looking bearish. Vice versa. If we're building below it, we should have a bearish outlook and not a bullish outlook. Now, on a day like today, you can use the previous day low, which was that support, as your next reject spot. So build up, build up, build up. We start building under it, we reject it into a new low of day, and we built below the opening range break low. So the beauty of the opening ranges is you can use them as your take profits. So on kind of a more rangier day like today, you can use this. So you got in at 714 and you took profits at 663. So with that being said, is you made 51 points. That is massive. That is massive, and that's all you really need. So you take your profit here, you let it run a little bit. As you can see, it ran a little bit at 642. Let's say you got at 642. So you made an extra 20 points. So you made 70 points. That is all you need, especially for a first trade. So I kind of like it for that aspect of you can use it as a take profit, and as when you start actively building under it, you can use it as a reject spot and a shorting spot. And it just gives you that confirmation of a trend. So, opening range break, you're going to use it on the 15-minute time frame to mark it out. You mark the high, you mark the low. On rangy days, your opening range break are going to be your friend. On trendy days, they're not going to be so good. But when it's ranging like this, you're going to be able to use them. Now, with that being said, you can also use it for a scalp, right? So you can kind of see we did reclaim the previous day low, we reclaimed it, and boom, you could use it as a TP because we're not really bullish on today. So your first TP, you let it build over that previous day high, you let it run a little bit. So let's say we started reclaiming, let's say you got in at 726. So you're riding the trend, you take your profit right here at 788, you trail your stop, and then you let it run another 45. So you made another 50, 60 points. What more can you want, right? So it's a good take profit. It's good for confirmation. It's good for establishing that trend, and it's just an overall good indicator. And, if you're kind of newer to the game, you can also just take plays off that, right? So you took a play here. You can see we built over it. You got in at 789. You got out at 850. That's perfect. Same thing on the flip side. You got in at 663. You got out at 620. What more can you need, right? So that is the beauty of it. So wrapping that up, opening range break, good on rangy days, not really great on trendy days, but it's on trendy days, it can be used as a reject or bounce spot for a deeper bounce or reject. Okay, with that being said, I went over the support and resistance. I went over the opening range break for confirmation, TP, and overall trend. Now, we're going to go over the EMA clouds. I use the EMA clouds by Ripster. They're all together, they're all programmed. What you're going to do is you're going to go on to uh, Trading View. You're going to look up Ripster. You're going to add EMA clouds and the trend label. So, the EMA clouds and the trend label. One more thing, you're also going to add the MTF clouds, which are basically like Bollinger Bands. So you're going to add those. Now, with that being said, today you can see clearly, let me actually no, I'm not gonna mark those out. You can see that it's really good for when you're in a trade to ride the trend, right? So a rule of thumb is if you're above the 512 and you're above the 3450, you're bullish, right? So you can see this red and green one is the 512 and this blue and orange is the 3450. So you can see once we reclaimed this and the opening range high, we were bullish because we were riding the trend and there's no reason to get out of the trend until the trend breaks. If you have your stop more kind of dynamic, you already took some profit, you can put your stop on the 3450, but as soon as that 512 breaks, that's when you should get out. Now, on the flip side, you shouldn't be shorting anything above the 512 and 3450 until the trend flips. So when you see the trend flip and the market's flipping, you can see we started building under the 3450 and under the 512. As soon as that happens, you're bearish and you shouldn't be longing anything. So you can see as soon as it crosses, that is when you're bearish. And you can see now we're riding the 512 to new lows. Okay? So that is the beauty of it. It is very good for identifying trend and using it as a stop loss and trend. Until the trend breaks, you're not getting out. The main time frames we're looking for are the hourly, daily, and 10-minute. The 10-minute is where you're going to identify your intraday trades. And then when you're in the trade, executed it already, you could drop down to the 5 or the 1, whatever you want to do. Now, you can see we're bullish, we're bullish, we're bullish, we're bullish, trend break. You shouldn't be trading in the middle. No trading in the middle. We break a previous support level. Trends flips. We're bearish, we're bearish, we're bearish, we're bearish, right? So now we're bearish. 3450. Above it, you're bullish. Below it, you're bearish. And then you ride the 512 for the trend. When the trend breaks, that's when you get out. So let's say you went long here, you went long here. The trend is starting to lose. The trend is starting to lose. Trend break, you're out. Obviously, you shouldn't be in that long, but you get what I'm trying to say here. The daily, you're going to use it to scope the deeper, um, see if we're deeper like bullish wise. So you can see we are overall bullish because we're above that 512. Same thing with the hourly. We are actually below it on the hourly, sorry. So we're bearish, right? So you're going to use the hourlies to scope the pivots and kind of where we are in relation to the chart. So you can see here we were bullish and now you can see we're bearish, and then you use the 10-minute to find your trades. Really simple. You use it to establish the trend, you use the support and resistance and the opening range for confirmations to get into the trade, and then you use the EMA clouds to ride your way up. So let me go back down to another example. So let's say on a more trendy day, sort of, we opened up. This was our 15-minute high, basically, this 891. Let's say you got in at 893, you got in at 893, so you're riding the trend, you're riding the trend, you're riding the trend. I'll say it one more time, you're riding the trend. You take your profit here, you take some more profit here, and boom, the trend breaks, you get out. The trend hasn't flipped, but the trend has broken. You could see we chop, chop, chop. We chopped for the next hour. Then the trend started to come back up, reclaiming the highs, but we didn't break that pivot, right? So that's where the pivots come in clutch because it's from the hourly chart, and you shouldn't be looking for, another trade unless we break that pivot. So that's kind of concluding everything. If you guys have questions, please reach out. I will break it down step by step, but I kind of wanted to give segments of it and kind of break it down for you guys. So yeah.